Hello, and thank you for joining our August Market Intelligence webinar. I'm Mike Farmer, the President of Commercial Operations for Builders FirstSource. We're very excited to have you here today, and we've got a great agenda that we're going to talk through here over the next hour. As a reminder, we have a Q&A section on the chat here. Please type your questions in, and we'll make sure we answer every question we can at the end of the call. I wanted to just highlight a few things for Builders FirstSource here. We're about 7 months into our merger, and we're very, very happy with where things stand as a company. It's been obviously a tremendously crazy year to get through and merge two companies together, but we're very, very proud of our teams, both corporately and in our field, who have come together to help service our customers in the best possible way. And just want to thank our Builders FirstSource team members for all their hard work and dedication to our company and our customers. This year, it has become more evident that we need to continue to do more pre-planning in the build cycle. And that's one of the biggest things we're talking to customers about, and we're going to talk a little bit more about on this call, is the more data and information we can have and the more timely information we can have from our customers and vendors, we can help make sure that we're keeping the building process moving as smoothly as possible. Couple things that we've seen is a continued increase in our ready frame product and wall panels and components. And we think that's a great area to look at as well here to cut labor off the job site and continue to improve efficiencies. Now I'd like to hand it over to Jessica Ehrlichman, the Senior Director of Strategic Sourcing and Sustainability from Andersen. Before that, I'd just like to say thank you to Andersen for being such a great partner and for sponsoring this call today.
Great, thank you, and hello to everybody. As an industry leader, Andersen has uniquely strong supply partnerships that have really allowed us to build a level of supply chain resiliency, helping us to resolve many of the critical issues across the Andersen enterprise. Many of those you all, I know, are also facing. And we know these challenges will persist in our current climate. And that's really why our Andersen teams continue to work tirelessly with our key supply partners, doing everything we can to resolve today's most pressing needs. The goal has been and is to constantly work to optimize the complete supply chain, the integrated supply chain, to create the most efficiency and effectivity in that overall order, plan, source, make, and deliver. Today, I wanted to share just a few strategies that we've employed within the Andersen enterprise to optimize our source of supply and manage a supply chain that we know remains fragile. This has meant optimization not only with the individual functions, but really we're focusing on excellence in the handoffs between product, process, and information between those functions. First up, Andersen has a dedicated team who's been working daily on identifying and prioritizing needs, allowing us to be swift and agile in addressing supply challenges. This has included leveraging our strong R&D team, who's diligently evaluating supply substitutions, ensuring our products deliver our high performance requirements. We've also been very disciplined in executing our S&OP processes. These have been critical to deliver accurate demand planning and frequent sharing with our supply partners. We know that evaluating that information is the right information and in the right format for those strategic suppliers is critical. Once we have that clear understanding of demand and availability of supply of raw materials, that has really allowed us to respond in a way that has meant our team members are required to engage in multiple tier supply chains. This has helped us mitigate backorder impacts while also assessing longer-term supply risk and supplier capabilities. In spite of the multi-tier support, baseline capacity of supply manufacturers and systems is being exceeded, and it has required some extended lead times across our product lines when certain features and options have been specified by our customers. This is really where the Andersen portfolio flexibility comes into play. It's been critical for us to leverage that portfolio flexibility to fulfill customer requests through an access to a range of products. The ability to flex the aesthetic and positioning within product hierarchy has been critical to continuing to deliver on the customer needs while managing against the challenges of the supply chain. And throughout these challenges, our Andersen supply chain and sourcing teams remain very grateful for our employees, our customers, and our partnerships across. We look forward to continuing to deliver the high quality products, services, and customer experience you've really come to expect from Andersen. Appreciate the ability to be on the call today, and I'll pass it back to Mike.
Jessica, thank you very much to both you and Andersen. Now I'd like to hand it over to Jeff Rettig and Steve LaValley from our BFS sourcing and supply chain team.
As we look out at all the building products, and manufacturers are working on slowly improving their output to meet the increased demand in the marketplace. They are still encountering some headwinds, however, that are holding them back from hitting their full stride. One of the larger challenges is transportation. We've all heard for some time now about the shortage of truckers across the nation, and as the economy continues to pick up, trucking's getting even tighter. As an option, more products are getting pushed to be delivered by rail, and now that's causing stress on that mode of transportation. In addition, some of the rail lines are being diverted out west due to the wildfires, and that's causing some delays in shipments. Product shipping from overseas, such as fasteners and trim, continue to see longer lead times due to the shortage of shipping containers and cargo space. And at this time of year especially, shipping container demand has jumped due to the demand from big box retailers trying to bring their product over in time for holiday shopping season. Hopefully, we should start seeing some ease in the beginning of Q1 next year on container ships coming from overseas. On the labor side, manufacturers are experiencing the same labor shortages that we're hearing from the builder community. And as the competition for the available labor pool increases, it's unfortunately causing wages to increase at the manufacturing level. And unfortunately, we're starting to hear some of the manufacturers report downtime once again due to rising COVID outbreaks. These rising transportation and labor costs are pushing many building product manufacturers to continue to announce price increases as we head into the end of the year. BFS will continue to source products from across the globe so that we can help keep our builders' projects moving forward, but it continues to get tougher and tougher as the world economy continues to pick up and increasing in competition for those products. To help you, we'll touch on a few ideas here in a couple of minutes to help improve your visibility into the supply chain, and so that you can help plan your building accordingly. Steve, on commodities?
Yep, thank you, Jeff. And so continuing with the headwinds narrative here, when we think specifically to the commodity lumber and sheet goods, I think there's a few other additional things to point out that Jeff maybe just briefly touched on. The Western wildfires, we can all look on the news every night. We're going to see the wildfires in Northern California, Oregon, Washington, Idaho, Southern British Columbia. These fires are very disruptive. And even though some of the mills are still, making product, able to ship product, there's definitely disruptions to the rail logistics network. I know that even with their own network, we see a lot of rail cars being diverted around Northern California that have to travel to the Southwest. And so these things just add time and costs to the material. Other things, increased log costs and various other costs of production, whether it's logs, whether it's labor, whether it's transportation, everything that a manufacturer or everything that a builder is going to experience as far as costs, as far as labor, is also going to impact your manufacturing base. So these are other places where mills and producers are going to have to tend to all these additional costs of the materials. Specific to Western Canadian lumber, well, not Western Canadian, but to lumber from Canada, more specifically to Western Canada, the increase in the duty deposit rate. We saw this story come out in the news probably back in April and May, and at the time it was when lumber prices were at all-time highs. And a lot of the story in the news was, how could you possibly increase the duties? Well, this is an annual calculation that happens on the duties on Canadian lumber coming into the States. And this annual calculation, based on how the metrics work, is due to show almost the doubling of those deposit rates, starting sometime probably close to Thanksgiving. And so, there's a lot of things that can happen in a lumber market that cause it to go up and down, but certainly a 50% or 100% increase in the duty deposit rate is probably not deflationary. So. And then the other one at the bottom there, headwinds on supply. From what we hear around the marketplace, there's been a weakening of the R&R and over-the-shoulder trade this summer. But as prices now start to come back lower, is that going to bring a resurgence of that business back into the marketplace? And so a few things, those are all, headwinds on supply coming into our channel. Next slide. Won't spend much time on these. I think it's a graphic that a lot of people in the industry have probably seen 100 times over, but obviously we had a historical run up to record highs on OSB and lumber prices. and then we've had a deterioration on prices since then. There's obviously a long lag in the supply chain, can be anywhere from 1 month to 3 months, depending on the product group. But these are all realities in the prices as we head into the back half of the year. Next slide. What do we expect tomorrow or coming up next in the lumber markets? It's hard to say. I think this is a companion slide to the slide prior, which is the record run-up in prices and also the deterioration on prices. I think the underlying demand, if we look at these numbers and look at the permits at pretty close to 1.6 million and housing starts maybe just north of 1.6 million. In that environment, I think the best thing that we can expect is continued volatility in the commodity markets. At the very bottom right, I've circled that one number, that 104,000.9 permits in June. Now, July numbers, we won't have those. Obviously, August, we're not going to have those. But I think we're still seeing a permits number that exceeds every month except for one over the last year. So in that environment, I think we should continue to expect further volatility in the commodities. Now, next slide will show a little bit of hope. So when we look at the commodity markets, there are a few things at play that I think have contributed. First of all, some of the weakening on prices or the softening to prices, but also as we start to go into the back half of the year next year, we've seen 2 OSB mills in North America restarted. All these are both public news. They're public manufacturers, and so you've been able to see this in the earnings reports. But West Fraser reopened a mill that's in Chambord, Quebec, and then Louisiana Pacific has now reopened and is starting to ship from a mill in Peace Valley, British Columbia. Those mills combined at full capacity are reported 1.3 million or billion should be square feet, which is the equivalent of about 130,000 starts that those mills could supply. So I think some of the weakness in the OSB market that's developed over the last 2-3 months is from these mills, not solely, but in part because these 2 mills reopened. And so hopefully the marketplace continues to absorb that material. It's material that was sorely needed in the back half of last year and the first half of this year. And so that'll be a little bit of relief on the OSB supply. I didn't get into too many details on the lumber production gains, but we do have a whole slate of southern yellow pine mills that are going to either greenfield projects or reopenings. And so we're going to start to see an increase of production in southern yellow pine. There's very little additional production coming out of the western U.S. or out of Canada. But if we skip over to the very bottom of the slide there, the exports, a lot of the export number is Canadian wood that would have been going offshore before. The Canadian exports going to Asia are almost about half of what they were 2 years ago. Now, with the deterioration of prices here lately, I think the Canadian mills, certainly the Western Canadian mills, are going to see a bit of a resurgence on some of that export wood going out. At this point, as it looks today, it looks like that's probably something that they feel like they need to do to keep the prices from deteriorating more. But I think those are all places where, as we look into the back half of the year and next year, there is some relief on commodity supply coming back to the market. Will it be enough to fill the gap between, here and let's say 1.7 million starts? Well, time will tell on that, but there's a bit of relief. So, Jeff, I'll kick it back over to you.
Thanks, Steve. So as we look forward and consider the new normal out there and a lot of products being on allocation, we're asking our builders to make sure you look at what is commonly available in the marketplace. Builders FirstSource is working with various manufacturers to streamline product offering to help provide a more consistent product offering in the field. Rather than bringing in 100 different pieces or 100 pieces of 5 different styles, it's more efficient and faster for the manufacturer and BFS to bring 250 pieces of 2 styles in so that we can help move your project forward with the right quantities. When you're designing your project, work with your BFS designers to optimize layouts and simplify designs so that we can align our product offerings with your product needs and use those products most efficiently. For example, work on removing EWP beams and headers where they're not structurally required, and look at using dimension lumber or open web options that can help simplify the package and help the project move forward out in the field. And we can't stress enough to work with your BFS sales associate to further the partnership between BFS, the vendors, and you. Create a timeline around your project and when you realistically need the product so that everybody's prepared. If a product is ordered too soon, such as windows or trusses, it can cause a buildup of product on ground before they're needed and cause undue stress and longer lead times to that categories. By setting realistic timelines and planning, we can work together to help your project go as smooth as possible. Mike, back to you.
Yeah, thank you, Jeff, and really appreciate that helpful information from both you and Steve there. I think the the key takeaway from my perspective there is communication, and working through some creativity with your local team is really critical right now, more than ever. And we just appreciate the partnership and support here, and we'll do everything we can do to keep you building and keep things moving forward. With that, I'd like to turn it over to Allie Wolf.
Awesome. Thanks, Mike. And hello, everyone. I am back again to go through the economic and housing update. As I pull up my slides, give me a second to do that. We have a lot to cover. I'm going to set my timer. We have 35 minutes where we are going to go through what's going on in the economy. There have been a couple interesting shifts on that front, and then we'll move to what's going on in the housing market. And frankly, there's been a couple interesting shifts on that front as well. So in case you're not familiar with who I am, I'm Allie Wolf. I am the chief economist for Zonda. Zonda is a housing data and consultancy firm. We track the entire building life cycle from raw land all the way up to the closing out of new home communities. We at Zonda have a really good relationship with Builders FirstSource. We love them as our really go-to advisors of what's going on the supply chain side. And for me, I have to talk to people at BFS and then step back and look at what's going on nationally, what's going on internationally, what's happening with policy. And I have to roll all of those things together to really get a sense of where is the market going. And as we know, it's kind of a moving target because we just learned something new about policy or how consumers are reacting to the market basically on a daily basis. Today's presentation, like I said, my timer is set. I have 30 to 35 minutes to go through these 5 sections. We'll start with the economy, home sales, supply challenges, and then some final thoughts and forecasts. To be honest, I'm a little bit bummed to be sitting here and talking about my first section, which is the economy and the virus, because I didn't think that I would still be presenting on the virus 16 months into this. But there have been a couple things that have happened professionally to me recently that I feel like if it's happening to me, it's probably happening to other people, and we just need to acknowledge that that still is a risk to the economy. I'll spend about 30 seconds in my entire presentation acknowledging it, but I'd be remiss if I tried to just pretend it wasn't happening. So as we look at the economy, and before we get into that, there was awesome news that came out 2 weeks ago. It was the latest report on gross domestic product, better known as GDP. This is the broadest measure of the overall economy. The reason I'm saying this is awesome news, and some of us are maybe still celebrating today, it's because the overall economy has not only made up to where we were before the pandemic, but we've exceeded those levels. And if you've seen any of the presentations I've done with BFS, the conversation is always about we had really swift and aggressive actions from the Federal Reserve and Congress. And when they were able to put all of this money into the system, they were able to drive growth, in particular for some of the higher income individuals. Note that on this slide, I have economy in quotes. And that's because you have a couple ways that you can look at the economy. Policy can certainly help drive gross domestic product, but it can't be as successful in terms of the overall labor market. So where we're standing today, 5.7 million fewer workers are working today compared to February of 2020. But boy, have we had a couple good months of job growth. June, July, we were averaging almost 1 million workers a month. And if we were to carry on that trend, it would take us just 6 more months for the labor picture to be 100% recovered. That's not our base case. That's not our forecast. We do think that there are some challenges, and you heard Jeff and Steve talk about it earlier. There are just some challenges finding qualified workers that's actually holding back the overall economy. But what's always important is looking at the makeup of jobs. Leisure and hospitality has been the hardest hit sector, remains the hardest hit sector, and is adding a lot of jobs. We're seeing a lot of growth in that sector. That's perfect, exactly what we want to see. When you look at construction, that's the second to last, showing 11,000 growth. That includes residential and non-residential. Resi is obviously doing better than what you see on the non-resi side, and we're now 60,000 more workers today compared to February 2020. What I think is a little bit misleading about that stat is that makes it sound like we're flush with workers and we're all happy because we have everyone that we need and we're not having to pay more money. we know that that's not the case. So even though we are up, we also know that the housing market looks very different than it did in February 2020. I'll have some stats on that a little bit later. And so that's why that's not really telling us that we're back to full employment in our sector, where I've actually exceeded it to the point that we're now struggling to find some workers. So here's my 30 seconds of the virus. Just take it, acknowledge that it is still a risk. The reason I want to highlight this is I've seen it both from friends. I've had friends reach out and say, hey, I was planning on taking this trip and I've decided not to. I just don't feel comfortable with the virus, where the virus is going. But I think more impactful, I've had now a handful, I would say 5 different presentations that were supposed to be in person across the country that have all moved to virtual for the rest of this year. And for these presentations, the way I just think about it is, well, if I was going to go back to business travel, I would have had to pay for my flight. I would have had my rental car. There would have been parking vendors that got my money, restaurants, hotels, plus the conference. And so as all of those activities are not happening and they're going back to virtual, that isn't necessarily a positive sign for that leisure and hospitality sector, though know that at least historically, when virus cases pick up, it's actually good for housing, because as people spend more time at home and as interest rates stay low, we, at least last time, tended to be the sector that was the beneficiary. As we look at the markets with the highest and lowest unemployment rates, I'll drop both of these in here. Know that the national unemployment rate is 5.4, so above where we were before the pandemic at about 3.5%, but geez, so much lower than when things got crazy and we were approaching a 15% unemployment rate. As I've mentioned before, and I'll keep saying it, just because LA, Las Vegas, New York, Chicago have a high unemployment rate relative to the national average, it does not mean their housing market is not performing just as well. In fact, Los Angeles and Las Vegas are some of the hottest housing markets across the country. So it's not as perfect or as easy to look at these numbers and draw a line to housing, but it does tell you that there's a higher concentration in some of the leisure and hospitality, some of the service sector jobs in the markets on the left. Markets on the right, you can see these are really kind of mind-blowing numbers, with Salt Lake City, Raleigh, Indianapolis having such low unemployment rates right now. The last thing I want to hit on the economy is what we've talked about with just some of the struggles on the labor front. The National Federation of Independent Businesses is a good source that I like to look at. They come out with a report every single month, and they talk to small businesses about what are some of the struggles. I'm sure no one's surprised to see that 46% of small businesses said that they had jobs that they could not fill. And you have 26% of firms saying their single most important problem in today's economy is the quality of labor. So that 26% means 26% of firms. Last year it was 19. So we have to remember that we did have labor challenges before COVID, even though I guess year over year was still COVID. But we know that we had some trouble finding quality workers in the home building space. The survey high was 27. Again, we're 26% of firms. So we're basically at the survey high going back to the 1970s. So if it really feels like you've never seen these kind of challenges before, that's probably because you haven't, or you haven't at least seen them since the 1970s. As a result, we have a record high number of companies that have needed to raise comp, the highest level going back to the 70s. And 63% of companies are hiring or planning to hire. And I think this is important because if you know that competition is there or competition is going to increase, then it's really incumbent on all of us as leaders in the industry to step back and say, well, what is our company's mission? What does our company offer? What kind of benefits can we give? Maybe it's not just comp, maybe it's flexibility, maybe it's culture. And so I do think there's a way that if we put some thought into that, we can try to help solve it. I know that's so much easier said than done, though. Second most important problem that small businesses are saying, taxes. I feel like enough said there. Third highest is inflation. And inflation was 1% of firms last year saying it was a problem. Now it's 13%. Survey high was 41%. But remember when the survey goes back to the 70s. So clearly that really high point was in the 70s. We're not facing that same kind of inflation environment, but we have had 47% of companies that have needed to raise their price. That's the highest level since 1981. So as we look at the economy, I just want your takeaway to be, we've had excellent growth and the economy is in such a better place than I think most people expected, even just a handful of months ago. But we do want to watch, and we're not going to pretend that we don't have some access to labor problems, that inflation is a risk that we're seeing. and just watch the Delta variant and the reaction from consumers and businesses. So with that aside, we know that housing remains one of the top sectors, one of the leading sectors in the overall economy. But there have been a little bit of shifts, and we need to acknowledge that and also put those shifts in perspective, because they don't have to be alarmingly bad or alarmingly scary, because frankly, they're not. So I've started to theme the months of the housing market. In June, the theme was shifts. When we met with our clients, we were saying, hey, you know, we see that sales have gone down. We see that some communities are now taking a little bit longer to sell all of their homes, or maybe there's a little bit of listings that are taking a price cut. That's not home prices going down. That's just a listing that's taking a price cut. And there were a lot of builders, our phones in June were just ringing and ringing because there was a lot of concern. I would say the theme for July is relief. Relief that, yeah, things are a little bit slower. The fever's broke. We're not going 150 miles per hour. We're going 120. So it's a little bit different, but we still have the majority of builders that say demand is stronger than expected, is on track with expected, or is slower than expected, but not worrisome. Note though, if you look at the fifth column over, you see 29%. That's 29% of builders that said they've seen some buyers pause because of rising prices. I think all of us expected at some point that would happen. July was the first time we did see a little bit of a jump in that overall number. As we went through our data, and by the way, this is from Zonda's Division President Survey, where we talked to leaders of home building organizations across the country. We really found in the survey that there were three camps. Camp one was these group of builders that said things like this: we had sales in July, but demand was slower than anticipated. Or not sure if slower demand is a result of a slower market or is self-induced by the run-up in pricing. And I think a lot of us could agree it's the latter, that a lot of builders did intentionally raise pricing to slow contract sales. And that's exactly what we saw happen. You have camp two of builders that said, we've seen no sign of a drop in traffic. We're still receiving offers well above asking price and demand is really strong. In camp three is, we didn't have sales in July because we didn't want them, because we didn't take them, because we're just trying to catch up. We're trying to deal with our shortages. And that's what makes really understanding the housing market today so muddy and so challenging. And I say, I talk to reporters probably every day, and I try to put all this data in perspective, that some of this is so incredibly intentional. And I'll show that in a moment on a different slide. What I wanted to throw up here, though, is just some of the herd on the street, some comments that we're hearing from our experts across the country. There is some talk of a price ceiling. There is some talk that incentives may need to come back to the market. This isn't an idea that prices are just going to drop, but it is that maybe someone needs a little help with the closing costs or something on the mortgage side. Not every single home is selling the same day it's listed anymore, but know that builders have really long interest lists. And if they can't get the first 10 to buy the home, maybe they get the first 20, and they just have to go a little bit further down that list. But the final thing I'll say, just to really hit on this point of the shifts, is that when Tim Sullivan and I, my coworker, were doing a presentation in January, we basically said, expect the first half of the year to be awesome. And we laid out the different reasons why we believed that. And I'm not here to pat myself on the back about that, because I think all of us could have said the first half of 2021 was good. I get that. What we had said, though, is just watch that second half of 2021, because affordability will get stretched. And as the vaccines get distributed, people will get distracted. We were very, very lucky that seasonality was notably absent in 2020. This year, we're falling back into a normal pattern. The phrase that we keep hearing across the country is normalization. Nothing freaky, nothing scary. It's just that we're not as feverish. And that's what we want to see. We could not have continued to maintain that pace and had a healthy housing market. You see here from Redfin, similar trend. You hit your peak where 74% of every single home on the market had a bidding war. Now it's 65%. Look at that 65, it's still high. It's just below where it was. And I think a lot of the charts that we're gonna look at shows a peak and then a little bit of a returning to normal, a little bit of coming back to earth. You see basically the exact same trend in our new home pending sales index. If you're not familiar with this, Zonda rolls together a couple different data sets to put together an index to tell you the state of the housing market. Right now, new home sales are up 2.4% year over year, and that's led by one of our two components. That's led by the average sales rate. The average sales rate to us is really a good gauge of looking at if builders have homes to sell and they're willing to sell them, how many are they selling? That number is still, you can see on the graph, it's the gray line, still well above where we were in 2019, well above where we were pre-pandemic. Total new home orders, a count of how many homes have sold, is back to 2019 levels. And the unfortunate thing is that the new home orders number is the one that gets produced from the Census Bureau, that makes the headlines, and it's one that doesn't shine the most favorable light on the housing market. But I'll show you data in a moment that shows what's happened to community count, and there can't really be an expectation for new home orders to be high if community count stays as low as it is. That's not a sign of demand, that's a sign of supply. We can see that here. This is builders that are making their sales caps. We still have 85% of builders that are intentionally slowing their sales. This is one thing that's going to impact all of the sales numbers, and it's something that I met with the White House recently. They didn't even know there were any kind of sales caps going on. So I think this is one of the underappreciated ways that the market is trying to control itself. It does become a little bit of a PR nightmare because some people think that it's just for profit margin reasons. In a lot of cases, it's really just to better align with production capacity. But either way, we're seeing it start to trend in the other direction, meaning in July, we now have 15% of builders that are taking contracts per usual. And we think July is the inflection point where each month now we're going to see more builders that are no longer doing severe sales caps, because in some cases, not every single home on allocation is selling anyways. To wrap up the idea on the pending sales index, the year-over-year change is a number that I'm not keen on anymore, just because of how weird last year was for the housing market. And in fact, we should expect to see some pretty negative numbers, some literally negative down year-over-year numbers in the housing market throughout the rest of this year. That's because of inventory, that's because of the sales cap, and partly because of demand. I don't want to pretend that that hasn't slowed. It has a little bit. But then you want to look at the two-year change. To me, what I love about the two-year change is it can show you markets that have been fundamentally altered over the past 2 years, that COVID has just been so good for them. And in a lot of these markets, on the left-hand side or the right-hand side, we're finding that they're the most active, and as they're the most active, they become the markets where getting your hands on supply becomes even more competitive and even more of a struggle. But you can see on the two-year list, you have some small markets, Port St. Lucie, Stockton, Naples, Sarasota. You have lots of Midwest markets, Cincinnati, Chicago, Columbus, Indianapolis. And then you even have big cities, which I think a lot of people would maybe be surprised by: San Francisco, Miami, Los Angeles. But then you look at that average sales rate. Again, this is one of the components of the pending sales index, but I just wanted to show you really what it looks like compared to 2019 with sales caps, that we're still outperforming those levels. Check out Phoenix though. Again, I think Phoenix is one of the markets that's going to tell us what some other markets will start to look like. Phoenix almost too hot for its own good, just running into some production capacity, running into a little bit of a price ceiling, and then frankly, just too much demand to match the overall inventory on the ground. Which is why the next place I want to go in this discussion is to look at inventory. We had called a few months ago that we believed resale inventory was at or near bottom. We have seen it lift up from the bottom, but you can see you barely can notice it going up in the most recent stats. So we haven't seen a flood of new listings on the resale side hit the market. We're still down about 45% year over year in terms of active listings, where really hot markets, Dallas, Orlando, Denver, Charlotte, Las Vegas, even more severe, down between 50 and 60%. Our expectation is that we do see more listings continue to hit the market. Some people are just getting enticed by how much they can sell their home for today. We just don't think we're going to snap back to those early 2020 levels really anytime soon. On the new home side, we haven't seen that bottom yet for community count, but our expectation is we will, in the next, I'd say, 3 to 4 months, start to see community count going back up. And that's good, because right now we've seen builders sell out of communities quicker than we can replace them. But as many of you know, Zonda has lot development data. We have vacant developed lots. We have lot under development. Both of those, well, vacant developed lots are at all-time lows, but lots under development have increased 14% year over year, which suggests in third quarter, fourth quarter, and then into the first and second of next year, you'll have more lots that will turn into vacant developed lots for builders to then start building on those. As we look at this, and we've talked about the demand picture and the supply picture, the natural result really for the past 16 months has been that prices have gone up. In July, that's where we've seen a little bit of a change. And I think the good news is we've started to see a little bit of consumer frustration at the same time that some of the building materials have at least stopped going up so much. They're still elevated, but it's not this continual runaway on some of the prices. As a result of what we're seeing, I think on the consumer side, with 61% of builders now saying that they are seeing hesitancy from buyers. As a result of that, 26% of builders in July took no price increase. That is abnormal. We haven't seen that really since last year. I think that's good. I think that's a sign that the builders are listening to the customers and saying, okay, we are getting a little bit of resistance and we don't want to shoot ourselves in the foot. We want to slow, tap the brakes a little bit, give people time to jump into the market. And even as you see the price increases that are happening, so obviously the inverse is 75% of builders are raising prices. We've seen the dollar amount shift to the left, meaning a lower dollar amount in terms of the total price increases. The thing that you have to understand, though, is the demographics are so good for housing, and builders do know that they are sitting on a desirable product. So while fewer builders are raising their prices in some markets and some of the hottest markets, positive net migration markets, you still have a very large share of the overall projects within the market that are raising prices. In San Antonio, Houston, Dallas, Tampa, Riverside, you have 80% of all the projects in those areas raising prices, up from between 40 and 50% this time last year. So what can people do? Because we know that there are some buyers that are hesitant, and you really have the option of you could live with friends and family, you can buy a home, you can rent a home. And the rental market has really taken a life of itself. It's fascinating to watch. We have a multifamily expert. Her name is Kimberly Byram. And what Kimberly called me the other day, and she said, this is the hottest rental market I have seen in my 30-year career. She is scratching her head. She said, this is crazy. Occupancy is 96.5% on a national basis. That's a lot higher than what you would expect. Normally, you're thinking around 95 is the level. We've done some presentations where the occupancy level is above 97%, we're approaching 98%. So if we talk about a shortage of for sale homes, you're also seeing a shortage of for rent homes. And the developers are taking notice. My same coworker, Kimberly, she has never been busier with requests that they want to build new multifamily communities. So I bring this up for a couple reasons. One is that that's going to now become competition. That's competition for some of the materials and some of the workers as that starts to pick up. But two is you kind of have people that don't really have a great option, because when you look at the rent to own equation, it's not that easy of saying, oh, well, obviously the math tilts to rents, let's just go to the rental space. Because again, in some of your hotter markets and some of your migration markets, rents in Phoenix up almost 20% year over year. Vegas, Riverside, Tampa, look at that, between 14 and 16%. So I think for a long time, there was fear that the rental market was going to be the next shoe to drop, at least for Class A. That's not been the case. And even as you go down in class, you still have people, if they get priced out of the for sale market, they want to go to rental. So just fascinating. Watch for the competition on labor, watch for the competition on supplies. I do think that will trend up as some of the deals that my coworkers working on start to come to life. So then let's look a little bit more into the supply challenges and the troubles with building a home. And this is a slide that I would think probably every time I've done a presentation with BFS, I've shown it. It's one of my favorites. I think it's good to track over time. And one of the points that I made to the White House is it's really easy to get frustrated with builders and say, just build more homes. But you saw from Jeff and Steve's presentation too, there are just capacity constraints. You're seeing that on the supply chain side, but you're definitely seeing that on the government side, where government services are not to their own fault, they're understaffed too, but they're creating huge headaches in the building community where entitlements are getting delayed or permits are getting delayed or costs are going up. Maybe not even the direct costs, but the fact that those delays are now taking it longer for builders and developers to move forward. There's a financing and a time cost that gets hit there. Labor shortage. This has actually increased compared to last month. Now you have about 70% of builders that say that labor shortage is one of their big concerns they're watching. 92% supply disruptions. Interestingly to me, I think we heard some talk earlier about some relief on the way. Right now, it's actually gone up a little bit over the past few months where builders say their supply disruptions have actually gotten a little bit worse. I don't have a slide on it, but I do want to mention that there's been an interesting shift where usually I talk about the top concerns from the builders, and it's consistently been building material cost, followed by building material availability, followed by affordability. That order has reshuffled. Now it's actually building material availability is number one. It's overtaking costs, and even affordability has overtaken costs. So the building material cost is number 3. Again, you see availability 1, affordability 2, cost is number 3. Then as we look at the final big concern in the market is the land disruptions. Like I mentioned, there's a lot of land development underway. A lot of builders were really active. The concern that I've heard is not really the immediate term of lots, meaning the next 6 to 12 months. It's what lots are available and how much do you pay for the land when you're trying to look out into 2023, 2024. The good news, and you heard this earlier in the presentation, is what's happening on the lumber front. When we talk to builders about what's happening on the ground, in June, very few, you had about 15% of builders that said they have felt any kind of relief. Looking at July, we're now at 50%. So we've seen big relief on the builder side. I think it's a huge just mental relief too, from it just going up, up, up every day to now seeing some of the reversing of those trends. But what this is doing, and I think this is a little bit unfortunate, is that lumber became so trendy that you couldn't talk about housing without talking about lumber. And everyday people that were not involved at all in housing knew what was going on with lumber. Well, now as lumber prices go down, those are the new headlines. Everyone's saying, oh, lumber prices are coming down. So consumers are reaching out to builders and saying, great, I see lumber prices are coming down, so home prices are coming down, aren't they? And that's not the case, and that's very unlikely to be the case. And I think that, going back to the PR of the sales caps, this creates its own PR challenges where the builders start to become the villain in all of this because people think, oh, well, one of your costs is down in a big cost, so why are we not seeing lower prices? And I think a lot of us on this call know the answer is because other costs have gone up. It's not that simple. Lumber isn't the only building material. And one of the ones that I wanted to highlight is just looking at what we see for land. When we do look at the land costs, you can see this is what do you estimate the change of the cost of land has been from last year to today. This was from our July survey. You can see 20% of builders say that they think their land costs had gone up between 16 and 20%. You have another 14, another 9 that are saying between 21 and 30% plus in terms of the cost of land. And then we ask them to look forward based on the conversations they're having, based on some of the deals that we're working with. What do you expect it will be in the future? And you still just have a lot of builders that think that cost of land is going to go up, something that's not as well reported because it's just harder to track land prices than it is to track lumber prices, but something that I really think we need to keep an eye on. As we look at permits and as we look at homes that are being built, we just pulled a selection of markets across the country, wanted to cover some different geographies. And you do see that permits are up in big markets and small markets, ranging from, and honestly, I was a bit surprised to see San Francisco up 56%, but coming from when last year San Francisco wasn't doing as well as it is today. You see Riverside, San Bernardino up 9%. But I think more importantly, this is looking at a long list. You got 25 of the top markets here by annual starts. And the way this is sorted is just Dallas, Houston, Central Florida, Phoenix, Atlanta are just your largest markets. They have enough land, they have relatively easy regulatory challenges, and so they're able to bring the homes to the market fairly quickly. You can look at those growth rates. For the top 5, between 14 and 33% in terms of total housing starts. Again, if you're operating in some of these markets that are at the top, you may be facing even more of the challenges that mentioned earlier. Maybe not as bad on the government side, though even in Texas, I hear that there are some big frustrations with what's happening on the city level. Showing this just as a different cut in case you wanted to see the areas that have changed the most, not on the percentage basis, but just by the total number. You can see still Dallas, Houston 1 and 2, but then a little bit of a change where Atlanta's 3. Interestingly, Southern California is 4, then Central Florida is number 5. You can see how those annual changes in the total starts have just huge, huge growth rates. Makes sense why this whole deck, the whole decks make sense based on this one slide, because of all of the different things that we're seeing on the labor front, on the supply chain front, on the land front, all come back to no one planning, no one having a crystal ball to know to plan for 35% growth. Final thoughts, a few things I want to go through here. The first is one that I find a little bit frustrating because you can't change some consumer's mind when they see something like this. So the media really loves to take this single family home price to income ratio and run with it. And there is no way to deny that this chart looks alarming. You can't. We have a home price to income ratio that is above what we saw 2005, 2006, 2007. But we are a monthly payment business. And the difference is interest rates were 5-6% back then. Interest rates are 2-3% today. Home prices can go up if interest rates are low. And we see that when you then cut the data differently, looking at the mortgage payment to income ratio. And you're looking at a completely different ballgame. You're looking at a completely different story. Now, let me make something clear. I don't think that our market has runway to get back to pre-2009 levels. I'm not saying, wow, we can get back to those levels we saw in 2005. I don't think that's the case. I do think we have a lot of things that have changed in the market. We have different lending standards. We have more money that we want to spend elsewhere, just a lot of experiences that pull from where people are putting their money, plus just this heightened jitteriness about the market. The great financial crisis is just too fresh for us to pretend that we can just go back to some of the ways that we were living before that. But I do think a recent example that we can look at is the peak that we saw at the end of 2018 and early 2019 when the market slowed. Market slowed because consumer confidence really got shaken and interest rates went up to 5%. So you can see we're below that level that we were in that end of 2018. We put in some hypothetical interest rates and said, okay, if interest rates got to 3.5, where would that put us? If they got to 4, where would that put us? The interesting thing, and I think a shift that we've seen in the market, is that in the past, 5% was the threshold that really crushed the housing market in 2018. Now, to get to the same place, given where home prices have gone, it's 4%. So we do have a little bit more sensitivity to interest rates than we have in the past, but I think all of us expected that given what we've seen with home prices. Now, if you've seen me present before, you've seen this chart. I know it's back again. The reason I want to show this though is because I had an interview with a reporter recently that basically said, I know why housing was good in 2020. In hindsight, we all can point to all of the reasons why that's the case. But why is housing still good in 2021? And it was such an easy question to answer because you just pull this up, you look at our main buyer groups, and you look at the reasons why we said housing was good in the first place. There's the non-COVID lifestyle changes, just getting married, having kids, that's always going to be there. You have the home equity, that's great. You have the stock market that's held up. You have the low interest rates that are still there, fear of missing out, increased savings, rising prices. All of these things are very big overall motivating factors for the buyers. Our top buyers remain the move-up buyer 1, first-time buyer 2, relocation 3. So I think as we do these presentations, I think I will dust this off every 4 to 6 months to make sure that those pillars of those motivations for home buyers today hold. If we start to see some of them falter, then maybe you need to start changing your tune on the overall strength of the market. As I wrap up with my starts forecast and my sales forecast, starts is no different. We actually have not changed our starts forecast from the last time we met. What I think is maybe a little bit odd to some of you is that we're performing under the year-to-date level. Year-to-date, I think it's closer to 20 or it's either 20 or 30% year-to-date year-over-year change. We're saying 13.4. We do think some of that is there have been some delays in starts. There have been some builders that have capped their sales. There have been some increased challenges on the supply chain that's just impacting overall growth. We could be under here for overall starts, but again, we're calling for 13.4. On the sales side, what makes it a little bit interesting is how different our forecast is for overall sales growth versus starts. We're calling for a 1.2% increase. The reason that's lower is really everything I talked about today. When you have community count that's operating low and you still do have 70 or 85% of builders that are capping sales, demand could be there. Again, yes, it's softened, but demand could be there, but you just can't hit the overall numbers that you would expect. So with that, Mike, I believe I am bringing you back in. Thanks, everyone.
Yeah, thank you very much, Allie. A lot of great information in there. Really appreciate you spending the time here with us today. It's interesting when you walk through all that and some of the national headlines start to talk about percentages, and you can tell whatever story you want with percentages, but the real numbers show we have a massively robust construction market or new home market and existing home market here continuing, and it's great to see that and appreciate all the information. So with that, I want to jump to the Q&A section of this piece. We've gotten a few questions that came in, and Steve, I'm going to flip this question over to you here. So the question is, we are still seeing very high price quotes in the U.S. in the Southwest in particular for lumber and sheet goods. We heard the prices are easing. When do you think we will start to see those prices easing in our region?
Thanks, Mike. Being the purchasing guy on this call, I've learned long ago not to dig too deep into sales prices in individual markets, but just generally from an overhead view, there's a lot of factors that go into cost, maybe, and what's the tail of cost going into the markets. Different geographies have different proximities to the mills. In one case, you may have a mill with a 2-week order file and it takes you a week to see the material. In other places, you're buying wood with a month-long order file and it takes 4 weeks to get these rail cars to the market. So you could have 8 weeks before you even see the material when you buy it from a sawmill. And so there's a lot of geographic nuances there. There's a lot of product mix nuances. The more of a particular market that's maybe, let's say, a southern yellow pine market is going to look different than a market that's western fir or spruce, just because of, again, it's the rail transit time, the truck transit time, typical lead times at the mills and stuff. And then those modes of transportation are also a key piece. Something we touched on earlier on the call is these western wildfires. We've seen transit times on rail cars. First of all, we saw several weeks where mills didn't even get rail cars. And then we're also seeing transit times out west that maybe they could be a 2 to 3 week haul on the rails. We're seeing 5-week transit times on some of these cars because they've had to take unusual routing to get around. I know up in BC there was a bridge that burnt down. There was one in Northern California that the bridge was severely damaged. So there's a lot of things that go into this. I'll just say that these trends happen. They take time, and when you see it in Randall Lengths to when you actually see it on the ground, it could be 45 to 75 days depending on the product group. So.
Yeah, and the other piece to that, Steve, I'd just add, I think that's a great answer. And I think the other piece is, part of the strategy we had this year was to beef up inventories to make sure we didn't run out for our customers. And so we probably did have a larger inventory position as the market started to turn down, but that's one we're going to work through as quickly as we can and help everybody keep moving forward. Jeff, this question is for you. As the lumber market and OSB market prices come down, has the LVL market come down as well?
No, the LVL market is still very strong out there, Mike. There's not a lot of additional manufacturing coming on board, as Steve mentioned, with OSB or lumber mills. So it's still very constrained, and the veneer prices are still elevated because of the shortage of veneers out there, and that's one of the big components on LVL. So we probably won't see any relief on LVL pricing, I would bet, for a year.
Got it. Thank you, Jeff. Question that came in that I think you're the right person to answer is, can you discuss Hardie pulling out of the multifamily market?
Many manufacturers are streamlining their offerings, as we mentioned earlier, to meet the high demand for the single-family market out there. It's just going strong, as Allie mentioned. Specific to Hardie, I'm not privy to their overall strategy, so I'd suggest reaching out to your local Hardie rep to find out probably the answer to that one.
Great. Thank you, Jeff. This question I'll actually take here, which is, how does the $1 billion stock repurchase plan affect the acquisition plans? Doesn't this create less free cash for acquisitions? Yeah, that's a really good question here, and this stock repurchase program is just a portion of our capital allocation. When you think about how you spend your capital, you're going to spend it on machinery and equipment, acquisitions, and then obviously the third leg is to be able to return some to the shareholders as needed. We feel very confident we can do all of those things for the long term here, and continue to invest in the business, do acquisitions, and do a measured share buyback. And so we don't anticipate that changing things at all. So another question is regarding BlackRock. They've heard that they've been buying 550,000 single family homes. What is the future of Wall Street buying? And if they're buying, why don't they buy directly from builders or buy them versus running up prices? I'm going to give that one to Allie.
Yep. Okay. So what I would say, and the reason that maybe they're not going as much to builders as you would expect, is that at least from our clients, we polled them actually a couple of weeks ago and asked about how many of their sales are investor sales, and 70% said, I think it was fewer than 5% of all their sales go to investors, and that's intentional. So as some builders will say, oh, I just want to offload this, yay, awesome, I got someone. And there are big institutions that come and try to buy from the builders. Again, some will do it, most will not. And the reason that some builders will not is because, one, they think back to the great financial crisis and they know that investors were some of the first to offload the homes. And so if something were to ever turn bad, the investors pose a pretty substantial risk to the integrity of their community. And then two, a lot of builders have been trying to pay attention to how many individuals just want to get their hands on a home. And they're trying, I think it goes back to PR again, I think they're just trying to make sure that the right people can get into their homes and they don't end up really upsetting a lot of people. I do think as long as interest rates are low, investors are going to be big in the market, and they're going to be particularly big in the entry level space, which is going to make it really hard for first time buyers who have not already purchased to be able to jump into the market.
Yeah, absolutely. Thank you, Allie. And a couple more questions for you while we've got you here. What will the impact of the forbearance program be to the overall market when it eventually ends?
Yep, and it's a really important question. There are so many moving parts to this. What I would say is you have to look at where the concentration of the individuals that are in forbearance, you have to understand that first. There are parts of the market where it's really such a small percent of the overall share that it's unlikely to move the needle. I can't remember exactly. I think it's either Louisiana or Mississippi or both. They have the highest share in the country. So you watch that part, you watch some of the areas that there's more distressed, but then you have to layer in what's going to happen to the overall inventory. Like we said, we don't expect it to shoot up. So we think that inventory will be constrained. And as long as home prices hold up, those homes that hit the market are not going to flood and make prices do this massive drop. And in particular, you want to watch which of the states are judicial versus non-judicial foreclosure states, because that can completely and substantially change the timing of when these individuals that are in forbearance that don't work things out with their lender, many of them want to and many of them will, that will play into that as well.
Great. And one more question for you, Allie. Who is purchasing homes in overvalued markets, in some of those hotter markets? That's allowing other buyers to relocate to new markets with large cash on hand to purchase.
Yeah, so I think the individual answered their question by asking the question. I wrote a New York Times opinion piece on this. What we've seen is that some of the markets that have really transformed have been areas that there have been more flexibility of work from home, or individuals that frankly are just okay moving and going to find a new job. They cash out their equity, they have their higher salary, they come in. In Phoenix, for example, you just see how many people from California come, bid up the pricing, and has really pushed some parts of Phoenix where you could normally buy an entry-level home for $250,000. Now you're looking at $400,000 for an entry-level home. So it's a lot of the migration trends. And then in some cases, it's people that just saved a boatload of money. Maybe they had good incomes going into the pandemic, but couldn't save. Now they still have their good income, they have their good credit score, and they have a down payment that's allowing them to jump in.
Yep. Thank you, Allie. One more quick question that we'll throw to Steve here, Steve and Jeff. Is it everyone's agreement that even though prices will drop for material, they will never go back to what they were before this all happened?
Jeff, I'll start with that and then I'll punt it over to you. Never is a very tricky word to throw out, right? We've seen extraordinary. In the last 18 months, we've seen record high prices, and we also saw prices that were low enough to have mills shutting down in 2019. And so I don't know if at this point I'd rule anything out. Even though I will say as time goes on, everybody's cost basis increases. So there's no producer that has a lower cost basis today than what they had 1, 2, 3, 4, 5 years ago. I don't know when that scenario changes. I don't know how they're going to get a lower cost basis. So therefore, their shutdown levels will just continue to be higher as time goes on. Jeff, what do you say?
I'll answer for the foreseeable future. I don't see a lot of additional manufacturing capacity coming in, whether it's in engineered lumber, roofing, insulation, or various building product categories. So I don't see a lot of overabundance of material. So I see continued strong demand, which is probably going to hold pricing where it's at.
Great. Well, thank you guys. That's very, very helpful. And hopefully you got some good information out of this call. We appreciate everybody spending some time here with us today, and apologize we went a few minutes over. Thank you again for your partnership, and we will look forward to talking to you again on our next call. Have a great day.